Introduction to Insurance. Chapter Objectives. Dear learners, after completing this chapter you are expected to define insurance, describes the basic characteristics of insurance, identify insurable risk, differentiate between insurance and gambling, distinct insurance and speculation, identify the benefits and costs of Insurancetto the society. Introduction. As stated earlier, there are a number of ways of dealing with risk. Insurance is one of the basic tools of risk management, and it is also the most important illustration of the transfer technique and the keystone of most risk management programs. Insurance is complicated and difficult to define. However, in its simplest aspect, it has two fundamental characteristics: a transferring or shifting risk from an individual to a group, b sharing losses on some equitable basis by all members of the group. To illustrate the way the insurance mechanism works, let you assume that there are 1,000 dwellings in a given community and, for simplicity, the value of each dwelling is but 10,000. Each owner faces the risk that his house may catch on fire. If a fire should break out, a financial loss of up to but 10,000 could result. Some houses will undoubtedly burn, but the probability that all will is remote. Now let us assume that the owners of these dwellings enter into an agreement to share the cost of losses as they occur, so that no single individual will be forced to bear an entire loss of 10,000 whenever a house burns. Each of the 1,000 owners contributes his proportionate share of the amount of loss. If the house is a total loss, each of the 1,000 owners will pay 10, and the owner of the destroyed house will be indemnified for the 10,000 loss. Those who suffer losses are indemnified by those who do not. Most who escape loss are willing to pay those who do not, because by doing so, they help to eliminate the possibility that they themselves might suffer a 10,000 loss. Through the agreement to share the losses, the economic burden these impose is spread throughout the group. This is essentially the way insurance works, for what we have described is a pure assessment of mutual insurance operation. There are some potential difficulties with the operation of such a plan, the most obvious being the possibility that some members of the group might refuse to pay their assessment at the time of a loss. This problem can be overcome by requiring payment in advance. To require payment in advance for the loss that may take place, it will be necessary to have some idea as to the amount of those losses. This may be calculated on the basis of past experience. Let us now assume that on the basis of past experience we are able to predict with reasonable accuracy that 2 of the 1,000 houses will burn. We could charge each member of the group 20, making a total of 20,000. In addition to the cost of the losses, there would no doubt be some expenses in the operation of the program. Also, there is a possibility that our predictions might not be entirely accurate. We might therefore charge each member of the group 40 instead of 20, thereby providing for the payment of expenses and also providing a cushion against deviations from our expectations. Each of the 1,000 house owners will incur a small cost of 40 in exchange for a promise of indemnification of the amount of 10,000 if his house burns down. This 40 premium is in effect the individual's share of the total losses and expenses of the group. Meaning of insurance. Insurance can be defined as a contract between two parties, where one promises the other to indemnify or make good any financial loss suffered by the latter, the insured, in consideration for an amount received by way of premium. In other words, the party agreeing to pay for the losses is the insurer. The party whose loss makes the insurer pay the claim is the insured. In general, insurance can be defined from 2 points of view. First, Insurance is the protection against financial loss provided by an insurer. It is an economic device whereby an individual substitutes a small certain cost of premium for a large and certain financial loss which would exist if it were not for the insurance. The primary function of insurance is the creation of the counterpart of risk, which is security. Insurance does not decrease the uncertainty for the individual as to whether or not the event will occur, nor does it alter the probability of financial loss connected with the event. From the individual's point of view, the purchase of an adequate amount of insurance on a house eliminates the uncertainty regarding a financial loss in the event that the house should burn down. Many persons consider an insurance contract to be a waste of money unless a loss occurs and indemnity is received. Some even feel that if they have not had a loss during the policy term, their premium should be returned. Both viewpoints constitute the essence of ignorance. Relative to the first, we already know that the insurance contract provides a valuable feature in the freedom from the burden of uncertainty. Even if a loss is not sustained during the policy term, the insured has received something for the premium, the promise of indemnification in the event of a loss. With respect to the second, one must appreciate the fact that the operation of the insurance principle is based upon the contribution of the many paying the losses of the unfortunate few. If the premiums were returned to the many who did not have losses, there would be no funds available to pay for the losses of the few who did. Basically, then, the insurance device is a method of loss distribution. What would be a devastating loss to an individual is spread in an equitable manner to all members of the group, and it is on this basis that insurance can exist. Second, insurance is a device by means of which the risks of two or more persons or firms are combined through actual or promised contributions to a fund out of which claimants are paid. From the viewpoint of the insured, insurance is a transfer device. From the viewpoint of the insurer, insurance is a retention and combination device. The distinctive feature of insurance as a transfer device is that it involves some pooling of risks, i.e., the insurer combines the risks of many insureds. Through this combination, the insurer improves its ability to predict its expected losses. Although most insurers collect in advance premiums that will be sufficient to pay all their expected losses, some rely at least in part on assessments levied on all insureds after losses occur. Insurance does not prevent losses, nor does it reduce the cost of losses to the economy as a whole. As a matter of fact, it may very well have the opposite effect of causing losses and increasing the cost of losses for the economy as a whole. The existence of insurance encourages some losses for the purpose of defrauding the insurer, and in addition people are less careful and may exert less effort to prevent losses than they might if it were not for the existence of insurance contracts. Also, the economy incurs certain additional costs in the operation of the insurance mechanism. Not only must the cost of the losses be borne, but the expense of distributing the losses on some equitable basis adds to this cost. Basic characteristics of insurance. The basic characteristics of insurance are pooling of losses, payment of unexpected losses, risk transfer, indemnification. 1. Pooling of losses. Pooling of risks or the sharing of losses is the heart of insurance. Pooling of losses means the spreading of losses incurred by the few over the entire group, so that in the process, average loss is substituted for actual loss. To accurately predict the future losses, exposure units in large numbers have to be grouped together to bring in the application of the law of large numbers. For this there has to be a large number of exposure units facing the same or similar kind of perils. In simple words, Pooling in an insurance context implies two things: sharing of losses by the entire group, and using the law of large numbers to predict future losses. The law of large numbers states that the greater the number of exposures, the more closely will the actual results approach the probable results that are expected from an infinite number of exposures. 2. Payment of unexpected losses. The insurer should cover losses that are unforeseen and unexpected and occurs as a result of chance. To put it differently, the loss should be an accidental one and a result of chance and not deliberately caused. 3. Risk transfer. In this, a pure risk is transferred from the insured to the insurer, who typically is in a stronger financial position and is willing to pay the loss than the insured. Example: the risk of premature death, poor health, destruction, or theft of property. 4. Indemnification compensation. Indemnification means the insured is restored to his or her approximate financial position prior to the occurrence of the loss. Requisites of insurable risks. Insurers normally insure only pure risks. However, all pure risks are not insurable. To be considered a proper subject for insurance, certain characteristics should be present. The following requisites are the ideal elements of an insurable risk. 1. There must be a large number of exposure units. There must be a sufficiently large number of homogeneous exposure units to make the losses reasonably predictable. Insurance size based on the operation of the law of large numbers. A large number of exposure units enhance the operation of an insurance plan by making estimates of future losses more accurate. 2. The loss must be accidental and unintentional. The loss must be the result of a contingency. That is, it must be something that may or may not happen. It must not be something that is certain to happen. If the insurance company knows that an event in the future is inevitable, it also knows that it must collect a premium equal to the certain loss that it must pay, plus an additional amount for the expenses of administering the claim and operation. Depreciation, which is a certainty, cannot be insured. It is provided for through a sinking fund. Furthermore, the loss should be beyond the control of the insured. The law of large numbers is useful in making predictions only if we can reasonably assume that future occurrences will approximate past experience. Since we assume that past experience was a result of chance happening, the predictions concerning the future will be valid only if future happenings are also a result of chance. 3. The loss must be determinable and measurable. The loss produced by the risk must be definite and measurable. This means the loss should be definite as to cause, time, place, and amount. The basic purpose of this requirement is to enable an insurer to determine if the loss is covered under the policy, and if it is covered, how much should be paid. 4. The loss should not be catastrophic general. Ideally, the loss should not be catastrophic, i.e., affecting a large number of exposure units at the same time, because most catastrophic losses, such as floods, earthquakes, and war, occur erratically and usually with great destruction. Both the frequency of occurrence and the severity of losses cannot be accurately forecasted, and thus catastrophic losses are usually not insured by private companies. Insurers can deal with the problem of a catastrophe loss by one reinsurance. Reinsurance is the shifting of part or all of the insurance originally written by one insurer to another, to avoiding the concentration of risk by dispersing coverage over a large geographical area. 5. The chance of loss must be calculable. It should be possible for the insurer to calculate the chance of loss with a reasonable degree of accuracy, as this is a major consideration in determining premium. 6. The premium must be economically feasible. Several requirements must be satisfied for an insurance company to be able to offer affordable premiums. First, the premium for the insurance must be affordable. Otherwise, few people would buy it, thereby spreading the risk among fewer people. With fewer people insured, the objective risk of the pool would be higher, because actual losses would be less predictable. Therefore, higher premiums would have to be charged to cover the increased objective risk. Secondly, the premium must be considerably less than the policy coverage, otherwise, people would simply self-insure. Check your progress. 1. Define insurance. 2. What is risk transfer? 3. What is meant by the loss must be accidental and unintentional. Insurance versus adverse selection. Adverse selection is the tendency of persons with a higher than average chance of loss to seek insurance at standard average rates, which, if not controlled by underwriting, results in higher than expected loss levels. Adverse selection can be controlled by careful underwriting, by charging higher premiums to substandard applicants for insurance, and by certain policy provisions. Underwriting refers to the process of selecting and classifying applicants for insurance. Underwriters determine if the policy should be written by the insurer, and if so, what premium should be charged and what restrictions should apply. Basic underwriting principles. 1. Selection of insured according to the company's underwriting standards. 2. Proper balance of insured within each rating classification. 3. Equity among policy owners. Insurance versus gambling. Insurance differs from gambling in two ways. First, gambling creates a new speculative risk that did not exist before, while insurance is a technique for handling an already existing pure risk. Second, gambling is socially unproductive, since the winner's gain comes at the expense of the loser. Insurance is always socially productive, since both the insured and insurer win. If the loss does not occur, gambling transactions never restore the losers to their former financial position. In contrast, insurance contracts restore the position of insured financially in whole or in part if a loss occurs. Insurance versus speculation. Both insurance and speculation techniques are similar, in that risk is transferred by a contract, and no new risk is created. Insurance differs from speculation. 1. Insurance transaction usually involves the transfer of risks that are insurable. However, speculation is a technique for handling risks that are typically uninsurable, such as protection against a substantial decline in the price of commodities. 2. Insurance reduce objective risk by applying of the law of large numbers. In contrast, speculation typically involves only risk transfer, not risk reduction. Check your progress. 1. What is meant by adverse selection and how it can be controlled. 2. Explain why gambling is unproductive. Benefits and costs of insurance. Insurance has peculiar advantages as a device to handle risk and so ought to be extended as far as possible in order to bring about the greatest economic advantage to a given society. Insurance, like most institutions, presents society with both benefits and costs. Benefits. 1. Indemnification. The direct advantage of insurance is indemnification for those who suffer unexpected losses. These unfortunate businesses and families are restored, or at least moved, closer to their former economic position. The advantage to these individuals is obvious. Society also gains because these persons are restored to production, and tax revenues are increased. 2. Reduced reserve requirements. If there is an insurance protection, the amount of accumulated funds needed to meet possible losses is reduced. One of the chief economic burdens of risk is the necessity for accumulating funds to meet possible losses. One of the great advantages of the insurance mechanism is that it greatly reduces the total of such reserves necessary for a given economy. Since the insurer can predict losses in advance, it needs to keep readily available only enough funds to meet those losses and to cover expenses. If each individual has to set aside such funds, there would be a need for a far greater amount because the individual, not knowing precisely how much would be required, would tend to be conservative. For example, above 60,000 residents can be insured against fire and other physical perils for about $200 a year. If insurance were not available, the individual would probably feel a need to set aside funds at a much higher rate than $200 a year. 3. Capital freed for investment. Cash reserves that insurers accumulate are freed for investment purposes, thus bringing about a better allocation of economic resources and increasing production. Insurers as a group and life insurance firms in particular have become among the largest and most important institutions to collect and distribute a nation's savings. A substantial part of the contributions of insurance companies is derived from regular savings by individuals. Through life insurance contracts, the provision of the life insurance mechanism, which encourages individual savings, is a most important contribution of insurance to the savings supply. The insurance mechanism encourages new investment. For example, if an individual knows that his family will be protected by life insurance in the event of premature death, the insured may be more willing to invest savings in a long-desired project, such as a business venture, without feeling that the family is being robbed of its basic income security. In this way, a better allocation of economic resources is achieved. 4. Reduced cost of capital. Since the supply of investable funds is greater than it would be without insurance, capital is available at lower cost than would otherwise be true. Other things being equal, this brings about a higher standard of living because increased investment itself will raise production and cause lower prices than would otherwise be the case. Also because insurance is an efficient device to reduce risk, investors may be willing to enter fields they would otherwise reject as too risky. Thus, society benefits by increased services and new products. The hallmarks of increased living standards. 5. Loss control. Another benefit of insurance lies in its loss control or loss prevention activities. Insurers are actively engaged in loss prevention activities. While it is not the main function of insurance to reduce loss, but merely to spread losses among members of the insured group, nevertheless, insurers are vitally interested in keeping losses at a minimum. Insurers know that if no effort is made in this regard, losses and premiums would have a tendency to rise, since it is human nature to relax vigilance when it is known that the loss will be fully paid by the insurer. Furthermore, in any given year, a rise in loss payments reduces the profit to the insurer, and so loss prevention provides a direct avenue of increased profit. By charging extra for bad features and less for good, insurers can induce the insured to make improvements which have beneficial effect on losses. This can clearly be seen, for example, in fire insurance, where the installation of good fighting equipment, such as a sprinkler system, receives considerable reward by way of reduced premiums. 6. Business and social stability. Insurance contributes to business and social stability and to peace of mind by protecting business firms and the family breadwinner adequately protected. A business need not face the grim prospect of liquidation following a loss. A family need not break up following the death or permanent disability of the breadwinner. A business venture can be continued without interruption even though a key person or the sole proprietor dies. A family need not lose its life savings following a bank failure. Old age dependency can be avoided. Loss of a firm's assets by theft can be reimbursed. Whole cities ruined by a hurricane can be rebuilt from the proceeds of insurance. 7.A to small business. Insurance encourages competition because without an insurance industry, small business would be a less effective competitor against big business. Big business may safely retain some of the risks that, if they resulted in loss, would destroy most small businesses. Without insurance, small business would involve more risks and would be a less attractive outlet for funds and energies. 8. Invisible export. A valuable contribution towards Ethiopia's balance of payments is made by invisible exports. These include banking, shipping and other services, as well as insurance, transacted abroad by the Ethiopian Insurance Corporation. Overseas insurance as an export is enhanced when the insurer is selling a commodity, namely security, to an overseas buyer. Although this commodity is invisible, it is an export in the same way as any material goods. Costs of insurance. 1. Operating expenses. Insurers incur expenses such as loss control costs, loss adjustment expenses, expenses involved in acquiring insureds, state premium taxes and general administrative expenses. These expenses, plus a reasonable amount for profit and contingencies, must be covered by the premium charged. In real terms, workers and other resources that might have been committed to other uses are required by the insurance industry. The advantages of insurance are not obtained for nothing. They should be weighed against the cost of obtaining the services. 2. Moral hazard. A second cost of the insurance industry is the creation of moral hazards. Moral hazard is a condition that increases the chance that some person will intentionally 1. Cause a loss or to increase its severity. Some unscrupulous persons can make, or believe that, they can make, a profit by bringing about a loss. For example, arson, inspired by the possibility of an insurance recovery, is a major cause of fires. Others abuse the insurance protection by making claims that are not warranted, thus spreading through the insurance system losses that they should bear themselves, e.g., claiming automobile liability when there is no negligence on the part of the defendant, to overutilizing the services, e.g., staying in a hospital beyond the period required for treatment. 3. Charging excessive fees for services rendered to insureds, as is done by some doctors and garages, and granting larger awards in liability cases merely because the defendant is insured. Some of these abuses are fraudulent, others indicate a different and indefensible code of ethics where insurance is involved. 3. Moral hazard. Another related cost is the creation of moral hazards. A moral hazard is a condition that causes persons to be less careful than they would otherwise be. Some persons do not consciously seek to bring about a loss, but the fact that they have insurance causes them to take more chances than they would if they had no insurance. Opinions differ on the degree to which moral and moral hazards are created by insurance, but all agree that some persons are affected in each way and that moral hazards are more common than moral hazards. In weighing the social costs and the social values of insurance, the advantages far exceed the disadvantages. Insurance is used because of the great economic services attained thereby. Functions and organization of insurers. As part of the study of the insurance mechanism and the way in which it works, it will be helpful to examine some of the unique facets of insurance company operations. In general, insurers operate in much the same manner as other firms. However, the nature of the insurance transaction requires certain specialized functions which require a suitable organization structure. In this section, we will examine some of the specialized activities of insurance companies and the general forms of organization structure, functions of insurers. Although there are definite operational differences between life insurance companies and property and liability insurers, the major activities of all insurers may be classified as follows: O. Production selling. 2. Underwriting selection of risks. 3. Rate making for managing claims. 5. Investment. These functions are normally the responsibility of definite departments or divisions within the firm. In addition to these functions, there are various other activities common to most business firms, such as accounting, personnel management, market research, and so on. Production. One of the most vital functions of an insurance firm is securing a sufficient number of applicants for insurance to enable the company to operate. This function, usually called production in an insurance company, corresponds to the sales function in an industrial firm. The term is a proper one for insurance because the act of selling is production in its true sense. Insurance is an intangible item and does not exist until a policy is sold. The production department of any insurer supervises the relationships with agents in the field. In firms such as direct writers, where a high degree of control over field activities is maintained, the production department recruits, trains, and supervises the agents or salespersons. Underwriting. Underwriting is the process of selecting risks offered to the insurer. It is an essential element in the operation of any insurance program, for unless the company selects from among its applicants, the inevitable result will be adverse to the company. Hence, the main responsibility of the underwriter is to guard against adverse selection. Underwriting is performed by Home Office personnel who scrutinize applications for coverage and make decisions as to whether they will be accepted, and by agents who produce the applications initially in the field. It is important to understand that underwriting does not have as its goal the selection of risks that will not have losses, but merely to avoid a disproportionate number of bad risks, thereby equalizing the actual losses with the expected ones, while attempting to avoid adverse selection through rejection of undesirable risks. The underwriter must secure an adequate volume of exposures in each class. In addition, he must guard against congestion or concentration of exposures that might result in a catastrophe. The underwriter must obtain as much information about the subject of the insurance as possible, within the limitations imposed by time and the cost of obtaining additional data. The desk underwriter must rule on the exposure submitted by the agents, accepting some and rejecting others that do not meet the company's underwriting requirements or policies. When a risk is rejected, it is because the underwriter feels that the hazards connected with it are excessive in relation to the rate. There are four sources from which the underwriter obtains information regarding the hazards inherent in an exposure: IV application containing the insured statements, 2 information from the agent or broker, 3 investigations, IV physical examinations or inspections. The application basic source of underwriting information is the application, which varies from each line of insurance and for each type of coverage. The broader and more liberal the contract, usually the more detailed the information required in the application. The questions on the application are designed to give the underwriter the information needed to decide if he would accept the exposure, reject it, or seek additional information. Information from agent or broker. In many cases, the underwriter places much weight on the recommendations of the agent or broker. This varies, of course, with the experience the underwriter has had with the particular agent in question. In certain cases, the underwriter will agree to accept an exposure that does not meet the underwriting requirements of the company. Such exposures are referred to as accommodation risk because they are accepted to accommodate a valued client or agent. Investigations. In some cases, the underwriter will request a report from an inspection organization that specializes in the investigation of personal matters. This inspection report may deal with a wide range of personal characteristics of the applicant, including financial status, occupation, character, and the extent to which he uses alcoholic beverages, or to which neighbors say he uses them. All the information is pertinent in the decision to accept or reject the application. For example, the financial status of the applicant is important in both the property and liability field and in life insurance field, although for different reasons. In the property and liability field, evidence of financial difficulty may be an indication of a potential moral hazard. In life insurance, there is concern because an individual who purchases more life insurance than he can afford is likely to let the policy lapse, a practice which is costly to the company. Physical examinations or inspections in life insurance, the primary focus is on the health of the applicant. The medical director of the company lays down principles to guide the agents and desk writers in the selection of risks, and one of the most critical pieces of intelligence is the report of the physician. Physicians selected by the insurance company or recognized medical centers supply the insurer with medical reports after a physical examination. This report is a very important source of underwriting information. In the field of property and liability insurance, the equivalent of the physical examination in life insurance is the inspection of the premises. Although such inspections are not always conducted, the practice is increasing. In some instances, this inspection is performed by the agent, who sends a report to the company with photographs of the property. In other cases, a company representative conducts the inspection. Rate making. An insurance rate is the price per unit of insurance. Like any other price, it is a function of the cost of production. However, in insurance, and like other industries, the cost of production is not known when the contract is sold, and will not be known until some time in the future, when the policy has expired. One of the fundamental differences between insurance pricing and the pricing function in other industries is that the price for insurance must be based on a prediction. The process of predicting future losses and future expenses, and allocating these costs among the various classes of insureds is called rate making. A second important difference between the pricing of insurance and pricing in other industries arises from the fact that insurance rates are subject to government regulation. Because insurance is considered to be vested in the public interest, all nations have enacted laws imposing statutory restraints on insurance rates. These laws require that insurance rates must not be excessive, must be adequate, and may not be unfairly discriminatory. Other characteristics considered desirable are that rates should be relatively stable over time, so that the public is not subjected to wide variations in cost from year to year. At the same time, rates should be sufficiently responsive to changing conditions to avoid inadequacies in the event of deteriorating loss experience. Makeup of the premium. A rate is the price charged for each unit of protection or exposure and should be distinguished from a premium, which is determined by multiplying the rate by the number of units of protection purchased. The unit of protection to which a rate applies differs for the various lines of insurance. In life insurance, for example, rates are computed for each 1,000 BER in protection. In fire insurance, the rate applies to each of BER 100 coverage. The insurance rate is the amount charged per unit of exposure. The premium is the product of the insurance rate and the number of units of exposure. Thus, in life insurance, if the rate is 25 per 1,000 of face amount of insurance, the premium for a 10,000 policy is 250. The premium is designed to cover two major costs, i.e. the expected loss and the cost of doing business. These are known as the pure premium and the loading, respectively. The pure premium determined by dividing the total expected loss by the number of exposures. In automobile insurance, for example, if an insurer expects to pay 100,000 of collision loss claims in a given territory, and there are 1,000 autos in the insured group, the pure premium for collision will be 100 per car, computed as follows. Pure premium equals expected loss equals per 100,000 equals 1,000. Exposure units per 100. The loading is made up of such items as agents' commissions, general company expenses, taxes, and fees, and allowance for profit. The sum of the pure premium and loading is termed as the gross premium. Usually the loading is expressed as a percentage of the expected gross premium. Property or liability insurance, a typical loading might be 33%. The general formula for the gross premium, the amount charged the consumer, is pure premium. Gross premium equals 1 loading percentage. In the above example, where the pure premium was per 100 per car, the gross premium would be calculated as per 100 equals per 150, 1 minus 0.333. Rate making methods. Two basic approaches to rate making, class and individual rating, are discussed below. Manual or class ratings. Manual or class rating method sets rates that apply uniformly to each exposure unit falling within some predetermined class or group. Everyone falling within a given class is charged the same rate. For example, a class rate might apply to all types of dwelling of a given kind of construction in a specific city. Rates which apply to all individuals of a given age and sex are also examples of class rates. The major areas of insurance that emphasize use of the manual rate-making method include life, automobile, residential fire, etc. For example, in life insurance the central classifications are by age and sex. In automobile insurance the loss data are broken down territorially by type of automobile, by age of driver, and by major use of automobile. In each case it is necessary only to find the appropriate page in a manual to find out what the insurance rate is to be, hence the term manual rate making. The obvious advantage of the class rating system is that it permits the insurer to apply a single rate to a large number of insureds, simplifying the process of determining their premiums. Class rating is the most common approach in use by the insurance industry today and is used in various lines of insurance. Individual rating. Under individual rating, each insured is charged a unique premium based largely upon the judgment of the person setting the rate. This rating is supplemented by whatever statistical data are available and by knowledge of the premiums charged similar insureds. It takes into account all known factors affecting the exposure, including competition from other insurers. If the characteristics of the units to be insured vary so widely, it is desirable to calculate rates for each unit depending on its loss-producing characteristics. Managing claims loss adjustment. The basic purpose of insurance is to provide indemnity to the members of the group who suffer losses. This is accomplished on the loss settlement process, but it is sometimes more complicated than just passing out money. The payment of losses that have occurred is the function of the claims department. Life insurance companies refer to those employees who settle losses as claim representatives or benefit representatives. Employees of the claims department in the field of property and liability insurance are called adjusters. The adjustment process. In determining whether to pay or contest a claim, the adjuster follows a procedure with four main steps: notice of loss, investigation, proof of loss, and payment or denial of the claim. The details of these steps vary with the type of insurance. Notice: the first step in the claim process is the notice by the insured to the company that a loss has occurred. The requirement differ from one policy to another, but in most cases the contract requires that the notice be given immediately or as soon as practicable. The policy usually requires that the notice be given in writing. Actually, however, oral notice to the insurer is usually sufficient unless the insurer or its agent objects. The insured may also be expected to notify someone other than the insurer. Under a theft insurance, for example, the insured must tell the police, as well as the insurer, about the loss. Investigation. The investigation is designed to determine if there was actually a loss covered by the policy, and if so, the amount of loss. Following the loss, the insured should assist the loss adjuster in the investigation. The adjuster must determine whether the loss actually occurred, to whether it is covered under the contract, and 3. the extent of the loss. Proof of loss within a specific time after giving notice. The insured is required to file a proof of loss. This is a sworn statement that the loss are stuck in place, and states the amount of the claim and the circumstance surrounding the loss. The adjuster normally assists the insured in the preparation of this document. Payment or denial. If all goes well, the insurance company draws a draft reimbursing the insured for the loss. If not, it denies the claim. The claim may be disallowed because there was no loss, the policy did not cover the loss, or because the adjuster feels that the amount of the claim is unreasonable. Investment function. When an insurance policy is written, the premium is generally paid in advance for periods varying from 6 months to 5 or more years. This advance payment of premiums gives rise to funds held for policyholders by the insurer, funds that must be invested in some manner. When these are added to the funds of the companies themselves, the assets would add up to huge amounts. These funds should not remain idle, and it is the responsibility of finance department or a finance committee of the company to see that they are properly invested. Not all the money collected by the insurer is to be invested. A certain proportion of it should be kept aside to meet future claims. However, the need for liquidity may vary from one state to another. Organization of insurers. The type of organization used by a given insurer and the types of departments created depend upon the particular problems it faces. The most common basis is a centralized management with departments organized on a functional basis. However, other bases, such as territorial, are commonly used, often concurrently with the functional type. Thus, the form of organization adopted depends on the scope of the line of business and the activities performed by the insurance organization. Based on the line of business, there are two basic forms of organization of insurers: single line or product organization and all line organization. Single line insurance organizations are those who deal only with one type business, say fire insurance or life insurance only. All line organization refers to that type of arrangement by which an insurer may write literally all lines of insurance under one administrative framework of a single organization. Example: the Ethiopian Insurance Corporation. Chapter summary. Insurance can be defined as a contract between two parties, where one promises the other to indemnify or make good any financial loss suffered by the latter the insured in consideration for An amount received by way of premium. In its simplest aspect, it has two fundamental characteristics: a transferring or shifting risk from an individual to a group, and b sharing losses on some equitable basis by all members of the group. The basic characteristics of insurance are pooling of losses, payment of unexpected losses, risk transfer, and indemnification. Insurers normally insure only pure risks. However, all pure risks are not insurable. The requisites for an insurable risk are: A, there must be a large number of exposure units; B, the loss must be accidental and unintentional; C, the loss must be determinable and measurable; D, the loss should not be catastrophic. Generally, the chance of loss must be calculable. F, the premium must be economically feasible. Adverse selection is the tendency of persons with a higher than average chance of loss to seek insurance at standard average rates. Adverse selection can be controlled by careful underwriting, by charging higher premiums to substandard applicants for insurance, and by certain policy provisions. Underwriting refers to the process of selecting and classifying applicants for insurance. Insurance differs from gambling in two ways. First, gambling creates a new speculative risk that did not exist before, while insurance is a technique for handling an already existing pure risk. Second, gambling is socially unproductive, since the winner's gain comes at the expense of the loser. Insurance is always socially productive, since both the insured and insurer win if the loss does not occur. Insurance differs from speculation in an insurance transaction usually involves the transfer of risks that are insurable, and b, insurance reduce objective risk by applying of the law of large numbers. In contrast, speculation typically involves only risk transfer, not risk reduction. The benefits of insurance includes indemnification, reduced to serve requirements, capital freed for investment, reduced cost of capital, loss control, business and social stability, aid to small business, invisible export. And the cost of insurance includes operating expense, moral hazard, and morale hazard. The major activities of all insurers are production, selling, underwriting, selection of risks, rate making, managing claims, and investment.